maybe you can give a little bit background on yourself, just so that everyone has context of who you are, what your background is, and kind of how you ended up at Capital One Ventures.
Sure. I think a lot of careers always are pretty zigzaggy kind of, and they only make sense when you reflect on it afterwards. So for me, right out of college, I went into this niche area of consulting known as economic consulting. Essentially, what we did is I like to say that you do math for lawyers, where you do a lot of damages valuations, antitrust evaluations, or international arbitration cases with the intent of what is the breach at case or what is the damages at case. So it's a weird mix of like financial valuation and data science in one. The outcome of that career was mostly to eventually get like a PhD in economics or finance, which isn't something I was truthfully too interested in at that moment. So pivoted my career, went to business school, went to Wharton, then went to Bain and Company to get a little bit more of a strategy consulting background. Spent most of my time at Bain in their private equity diligence group. That's doing diligence for large buyouts, some growth equity investments. Really liked kind of understanding a lot of the startup investments that happen, but wished I worked on them a lot earlier stage rather than kind of like that pre-IPO stage. And so found this career at Capital One Ventures where I got to mirror a lot of like what I enjoyed from a strategy consulting perspective with a lot of the investor skills I was building at Bain and Company. So found it really interesting. I'm mostly a fintech investor. That has been for us B2B and consumer fintech. I found the space super interesting because it combines a lot of the finance knowledge I've been building, as well as a lot of the technical new tech that's been going out there. And so I've been finding it super interesting so far.
Got it. And would you say that's a fairly, you mentioned zigzagging in your career, but like, would you say that's fairly typical where you see VCs with some, strategy consulting or some sort of tangential work beforehand? Is that typical, or do you see people who are founders, or what has been in your experience?
Yeah, I think it's like the nice part about this career is there's so many like entry points that someone can make, which either you can come in as the operator side, you started a company, you scaled it successfully, or you were part of like the go-to-market team or business development team at a startup and scaled it successfully, and then pivot your career into venture. That's been a super successful models. Other people come from like more of a software engineering or product management experience that leverages a lot of the skills that they built there for like the technical diligence component. And then you have this other subset of people come in from like investment banking or consulting background, which has more of the commercial diligence piece and understanding of markets. I can't say like which model has always been the most successful. I think you'd find great investors in each of those. I think they just come in with different skill sets, and hopefully the team that's surrounding the investors from the investment committee at the venture fund will be diverse and incorporating all those different perspectives.
Great. And, part of the reason why we wanted to have you for one of these talks is you're at a corporate VC, which is a little bit different. Maybe we can just start at a high level, generically to like corporate VCs versus traditional. How should founders think about a corporate VC versus first of all, could you help us define what that means and generally how they work on one side versus the other?
Sure. There's a simplistic understanding of like a corporate VC is really when like you have one LP at the end of the day. It's a corporate entity that's backed by that the VC is backed by, versus a financial VC will tend to have like multiple LPs or financially oriented LPs. Within CVCs, there's kind of also a spectrum. It depends on how strong or strict they are with their like strategic mandate. On one side of the spectrum, you have kind of like what I would call like loose strategy focus. You can think of these as like the Google Ventures, Salesforce Ventures, or NVIDIA Ventures of the world, where there's kind of like a idea of a strategy, which is I want to be an incubation of new technology that's built on top of what I have built. And so you can seed a lot of investment companies and startups that will use that technology and create an ecosystem there. That's like hard to really measure the strategy at the end of the day. And so the default tends to be like, did you make a financial return, or did you generate returns for your sole LP? On the other side of the house is what we would call like kind of like strict strategy mandates, where it is very clear what the mandate is for them. It is to both generate returns, but also to find strong partnership opportunities with the corporate entity and startups that are win-wins for both the startup as well as the parent company. So those would typically arrange into like some sort of commercial partnership or a pathway of getting to a commercial partnership at the end of the day. And so having that kind of pathway isn't just providing capital, but also distribution, scale, consumer relationship as well. And so there's added benefits to that, I think, that aren't just simply just providing like a term sheet or capital at the end of the day.
Got it. And is it obvious to founders what each CVC's mandate is? Because I can imagine, obviously many of these corporate VCs have the solo LP company in their name. But it's hard, it might be hard to understand like what their objectives are, or maybe it isn't. Do you find like that's pretty visible on like their websites, or it's easy to do that research, or you have to really dig in to see like kind of how you might fit in with one of these?
Yeah, I think it's usually through a conversation, truthfully. It's kind of hard to understand like from the portfolio companies because you might look at a CVC and they'll have like 200 portfolio companies and you're thinking, oh, they're kind of like an accelerator program. And you'll see other CVCs that have only like 20 portfolio companies and they're like, oh, more strategically focused. But that might be a bad bifurcation of it. It's really like they exist on that spectrum too. Like there's a lot of CVCs that also exist in the middle, which are like financially motivated, but also strategically motivated, which is I think where we kind of sit, where we want to not lose money and also generate returns at the end of the day, but also in a way that's strategically beneficial for the company. And so usually that's through like a conversation, back channeling some of the portcos. Like if you're a founder, generally like having a strong network with other founders is super important. So like back channeling with any of the other founders who've interacted with those funds before would be super important to know like where on that spectrum exists, or if you're in conversation with one of those funds, clearly like just ask up front, where are you more financially motivated, strategically motivated, and what does strategy entail for you? Is strategy a signed commercial partnership? Is strategy a pathway to get to a commercial partnership? What does that actually mean for that entity at the end of the day? So having clear guidelines in terms of what that actually works out would be super beneficial usually for a founder.
Got it. And would you, from the founder's perspective, is there clear advantages or disadvantages from going kind of the traditional VC route or the corporate VC route? The one you obviously said is like pathway to a built-in customer set, given like, it might be a customer you're selling to, but are there other like advantages and disadvantages to taking money from one versus the other?
I think the truth like depends on what the founder's like motive is. If you just want capital at the end of the day, it's probably better to work with like a traditional VC or like a financially motivated CVC where they can get you a term sheet in a pretty quick manner if they have conviction, where they can move pretty fast. If it's more strategically focused, like you need capital, but you also need customers and you need more importantly, like distribution. That is a process that runs much longer and probably involve more of a strategically oriented CVC. And so that type of process, if you that's what you're after, because going through a distribution play lowers your customer acquisition, provides you scale, recurring revenue, all of those things that are baked into it is super helpful for a lot of startups, especially when they're hitting scale or post product market fit. And so that's been beneficial, I think, for a lot of CVCs to start having those conversations with startups at that stage. If you're more earlier, where you're a seed stage company, where you're just really looking for a lot more capital-oriented investors, then probably have conversations with CVCs to understand their mandate and have that network. But you probably still want to talk to more of those financial or traditional VCs to kind of help you hit scale, where a corporate entity can come in and actually be a great distribution partner at the end of the day. And by the way, just like illustrate that difference a little bit between just like a CVC could either be like a vendor-vendee relationship with a startup where you truthfully are just consuming SaaS at the end of the day, or it could be a distribution play where if you want to be more of a B2B to C business, where you can use the Fortune 500 company to distribute to their end customers, you can kind of latch onto that and play into that distribution play. And so like understand like if that's a route that you're interested in as a startup is super important, like having that play, because that's an easy way of getting distribution scale, especially when you're hitting pretty late stage type companies.
Got it. And would you say is the invest, and again, we're just for the audience, we're just still talking generally CVC. So none of this is specific to one firm, but Have you seen that the investment process differs much? And maybe you have to break it out the way you're doing as pre-seed versus maybe seed Series A might be different.
Yeah, I think broadly, like the investment process of any VC is like sourcing, diligence, closing, right? And so in each of those phases, there's like slight nuance differences, but it's really in the diligence phase that I think it shows itself mostly. In the sourcing phase, like every CVC is like talking to startups, having like intro conversations the same way that any like traditional VC is having it. It's really in the diligence phase where not only are you doing like the typical financial diligence of like, here's my data room, here's like my investor deck and all those things, you're also having to go a deeper level where you're actually talking to like their lines of business. So for instance, the product manager or technical lead who might be involved in actually like integration if you're going through a vendor relationship with the Fortune 500, then that becomes like a pattern where your diligence process is going to be a lot more detailed and a lot deeper than you're probably exposed to on the traditional VC side. And you're exposed to a lot more like risk protocols that are associated with like larger corporate entities that you might not get the same kind of scrutiny with on the traditional VC side. And so that tends to go a little deeper, as well as on the closing process, like the legal diligence, the closed docs might also be a little bit more detailed, given all like the I's and O's to dot, especially if you're like working with like a bank partner.
Got it. Yeah. So they might be doing diligence that you're not used to, or it's not an angel like writing a check off of a 15-minute conversation. You might have to go through some committees or such.
Yeah, I'd say that just like more support needs to be around the table versus just like the IC at the end of the day. It needs to be like multiple hands raising their hand up that this is an interesting startup.
Got it. Got it. And what about in terms of the outcomes they're looking for? So a lot of these talks, often what we touch upon is the venture math, right? What VCs need to see in terms of outcomes, and that's kind of their mandate. Do you find that corporate VCs, again, other than the ones that are maybe looking for interesting companies to acquire along the way, like are they looking for different outcomes? Is the math still the math, or is it potentially a little bit different?
I'd say like broadly the math's the same. Is like the MOIC needs to be high and the IRR of every investment needs to kind of justify that at the end of the day, because you don't want to waste balance sheet capital for like no or for frivolous purposes, because you can just invest that in your business. But there is like that angle of like strategically what is the benefit. And so like if there's a commercial relationship, then like the spend that would happen if it's a vendor vendee relationship is important to know, as well as the incremental efficiency gains or whatever will be associated with that. As well as if it's a distribution partnership play, it could be like a revenue share agreement where there could be revenue at stake that entices both sides of the table. And so that could be like a pool of money that's also computed within that kind of MOIC calculation. That's important to consider. And there could be even like the softer stuff of like NPS increasement or customer satisfaction and those type of things, which are important to play in, but that might not actually tangibly come out to the calculation. And so I say all that to say like they might be able to take like a lower returns threshold maybe than a traditional VC and take a little bit more risk, but there has to be justified in the end with like something that backs out into like a strategic value pool number that will justify that leap in that direction.
Got it. Got it. Okay. Now, maybe zooming in a little bit to Capital One Ventures, maybe actually to start, it would be good. Could you just describe Capital One in general, like the broad business, just to level set, because we have some international and folks maybe that might not be familiar, even though it's a very well-known brand name in the US at least.
Yeah,
Can you just describe that first before we get into the investing part?
sure. Large bank in the US, predominantly US based. So I think has some entities in the UK and Canada. Top 10 banks, so that implies heavy regulations in the US through all the stress tests and Fed oversight. Majority of the big banks have some sort of CVC arm, so this is not really too different than I think most of the other banks. They look for the same types of partnership plays where they can use startups and both in their internal tech stack within kind of like as a technology vendor, but also as potential benefits to their end customers. For us, when we talk about end customers, that is generally like cardholders, bank relationships, both on the personal side, consumer side, as well as the business side, and then commercial relationships as it relates to like capital markets and those things. And so broadly, it's kind of like traditionally how we think of like our banking institution. Predominantly, like if you look at it from like a revenue perspective, we're mostly like a card company at the end of the day, a credit card company, and that's where we drive a large part of the profit pool. But we also offer all those other like banking features as well.
Great. And in terms of capital and ventures, maybe at a high level, can you just tell us like what do you invest in terms of like sectors, stages, and whatever you can kind of um, highlight there?
Yeah. Broadly, we have like two practice areas. One is enterprise tech, which you can think is just like B2B SaaS. And then we have fintech. Fintech is more where I sit. That could be both consumer fintech as well as B2B fintech. And so for B2B for us, it's really like small business type fintech tools. Think of a lot of the ecosystem that's evolved in small business, both lending, payments, payroll, HR, all those services that exist today. Um, Generally, from like a check and stage perspective, it's a bit of a broad mandate. I wouldn't say there's like one rule that applies to every situation, but I'd say like 80% of the time it tends to be like a Series A onwards investment. 80% of the time it tends to be a check between 5 to 15 million. And 80% of the time it would be us also coming in with other syndicates or other financial investors involved at the end of the day through like a priced round.
Yeah, great. So, based on what you said earlier, I mean, if some of our founders on this call like think Capital One Ventures, oh yeah, they got or Capital One, they got credit cards. My thing isn't a credit card startup. It's they shouldn't just limit themselves to creating relationships because you really have to what you said earlier, explore what they invested in and why, and it might be a better fit than you think.
Yeah, I mean, though if it's like a healthcare startup,
Yeah,
probably
yeah, it's like yeah,
it's a
it
little bit
can't
of a
be
stretch.
wildly off, but
Yeah,
you
yeah,
know,
but broadly, like anything that's a fintech product, and
yeah,
fintech itself is also a pretty broad term. It encompasses so many different types of products and business models that could generally be consumed by us, as well as anything on enterprise. If it's a B2B SaaS type business, and it would be something that a large enterprise would try and consume, that would also be applicable to us as well.
yeah, great. And then, just getting into your own personal perspectives on investing, maybe to start, something you just said about where you invest, where Capital One Ventures invest, maybe a lot of Series A and beyond. Um, how early are you starting to get eyes on companies? Like how early are you tracking startups, knowing and seeing their traction and progress as they get to that Series A? Just to kind of illuminate a lot of these talks, what's most helpful is like most of the founders haven't been in your shoes as an investor. So just to get into your mindset of like when you start tracking some of these things would be helpful.
Yeah, I would say if I'm good at my job, then it means I'm generally tracking at like the seed stage and like knowing like who's getting or who is launching products of interest that will probably get traction at the Series A stage and onwards. Um, but in truth, like there's so much noise, I think, at the seed to pre-seed stage that's always hard to truthfully pick out every winner. And so the opportunities that I get are and I evaluate and have like my sourcing conversations with might also be a fraction of like truthfully what reaches the escape velocity of Series A. But generally, like I'm trying to scan the market in the seed market to know where they would be a good fit longer term. I do that more opportunistically to make sure like I'm tracking things earlier and having those relationships pretty early. And so that would be true for a lot of CVCs where they will have networking conversations in in a startup's journey pretty early, especially if it's promising, but without ever like thinking they're going to invest at that point. Where I do like a pretty good chunk of my sourcing tends to be on that Series A onward stage too. And like those are startups that generally are out there and that have like established a pretty good name brand recognition that like it's pretty easy to know a lot about them. And so that is like more of just like networking with like other investors and networking within the startup community itself. That one's more of like the tried true like venture pound the table and talk to people type approach.
Yeah. And on that seed stage, like what I can imagine this Series A stage, you'll start knowing about it, you hear about them, other, like you said, other investors are talking about it. You obviously have a great network of pre-seed investors and seed investors who you're probably in touch with fairly regularly. But on the seed stage, what are some of the ways that things attract you? Like, is it could it was it like press? Is it like your own like noodling around in different communities? Like I'm just curious, like what are some of the ways that start to get on your radar?
Um, there's like the internal biases that are associated with this, which is like, oh, a great financial VC that I really respect at the seed stage was
Yeah.
involved in around, and so that could be indicative that at least I want to have a conversation with it. I wouldn't say that always holds out. I think there's also still like my internal thesis of like, I think XYZ is going to drastically change X like this market, and I should proactively be looking at new startups that are actually innovating in that space. If it's truthfully like a very innovative solution and there's not really a defined market yet, you're probably going to have to be like digging around the seed stage companies to actually like understand it, and like find companies that are interesting. And so like that involves a little bit more like I have an idea, I go from that thesis and I find startups that are actually interesting and start identifying them. And that goes a little bit to general traction. Do I think the founder themselves have good domain knowledge in this industry, as well as like the determination and grit to actually like go to market and like pound the table to actually win deals? As well as like, do I actually think they're creating a differentiated experience through their technical products? And that I leverage both like my own knowledge, but as well as like product managers and technical leads within Capital One to help me out with.
Got it. Yeah, and I think it's easy for founders to forget your perspective. You're trying to track potentially thousands of companies that are kind of making their journey, and it's almost impossible to kind of track every company to the level that you'd ideally want if there's unlimited amounts of time, but you have to use some shortcuts to try to figure out how to get some signal out of what company might be interesting to you. So that's super helpful. In terms of your personal kind of approach to investing, when you think about investing, what's kind of unique to your approach, or a way that you maybe approach it that might be a little different than other investors?
I don't know if it's too different, but it's a bit of a playbook I got from when I was in Bain in terms of how they approach diligence, and it tended to be a little bit more towards like the buyout model. But I think there's a lot to learn, especially it's related to growth stage or startup investing, which is generally like where do you want to play and how do you want to win in this market? And so it tends to be like a Y and X or a 2x2 of like where to play, how to win. Where to play generally be it's like, is this an attractive market? This is all the thesis driven stuff you hear about in VC of like, is this an attractive market? Are there good tailwinds? Do I believe in the business model that's underlying a lot of these startups that they're innovating on? And then the how to win for me is more of like what differentiated offering would Capital One or myself bring to the startup besides just capital, advice, mentorship, access to my network as well, or even broadly to access within Capital One. That is where I think, truthfully, the more nuanced approach is, because I think a lot of people tend to have like, there's a lot of interesting theses and how markets are shifting, especially in fintech right now. Some of that might be even regulatory driven, some of that might be new technology driven. But then that how to win approach is really where I think like, what unique offering would I have at this stage that isn't just capital at the end of the day that would actually enhance or accelerate the startup's journey? And so that's generally like how I play. And so sometimes it could actually be like a great startup that actually like, is going to do really well and raise a lot of money and like kill a market. But I didn't really think had conviction that like there's a lot of value I can add at that stage. Whereas there's startups that might not have actually been from the outset like working in a large market or what someone would consider like a large TAM, but actually like there's a lot of value at play that can be enhanced and actually realized through a partnership. And so that's broadly kind of how I think about it.
Right. And when you say, I'm just curious what you view as some of the more interesting trends in the market as it relates to fintech. Particularly, well, not particularly. I think you just mentioned certain regulatory shifting sands, which I think, my background's in crypto and blockchain, and there's certainly been a lot of regulatory I don't know, shifts, I want to say, that have changed people's strategies. But are you seeing other trends that you think are particularly interesting to track in terms of opportunities or markets or technologies that you think might be interesting, or something to watch?
Yeah, I think like it's weird in fintech where it's like a lot of like finance has been tried in some extent. It's really like what fintech exists, take like an old concept of finance and digitize it and provide it in a different manner or channel. And that's really kind of like it at the end of the day, where it's like, okay, B2B payments, but through virtual cards or something like that. Or if it's embedded lending, but digitized and through a digital experience and onboarding. And so like a lot of that really exists like funnel and change a little bit, but it's not truthfully like innovating on an underlying business model. And so I think still like a lot of things like that, like regulation and a lot of like the macro tailwinds tend to drive the fintech market at the end of the day. And so broadly, like within regulatory space, there's a lot of talk around like open banking and what that means. And CFPB has yet to rule in terms of like 1033 of like what they think with open banking rules. But there's a lot of interesting things that could spun out of that where actually it becomes like a catalyst for a lot of startups to innovate and create a lot more innovative data tools and data pipes between banking institutions, between merchants and banks, between consumers and their merchants. It basically creates a lot of accessibility within consumers to their financial data. Is really user permissioned. And so there's a lot of interesting startups that can be built on top of that, especially given those regulatory tailwinds. I find that super interesting. Is this like the downside of regulation and how it could like even affect an industry? And you see that with like a lot of the consent orders that are happening with like banking as a service right now and a lot of those middleware players. And so it's always important, especially to understand like how regulation could be hampering your industry and potentially harming startups. I think that you've seen that the case for like a lot of the BaaS providers in that space.
Cool. And one last question before we turn it over to Dorothy for questions from the audience. If anyone has a question, please DM Dorothy. She's organizing them. Try to get to as many as we can in the 10 minutes we've got. In terms of your own process of engaging founders, can you just walk us through like a typical way that you go through building the relationship and getting a deal across the line, just to give the founders on the call a sense of the timing and the engagement models? We've heard some from other investors where it could be as short as a couple of weeks. These might be pre-seed kind of quick deals, but how about you? Like what's that process typically look like?
Um, if there's strong conviction and it tends to be, and happens, I think, more in the latter stage of like probably Series B onwards type investments, those can move kind of quickly in terms of like, I already know who the players are, and especially when you hit the escape velocity of like later stages, there's only so many players in those markets that you could kind of get conviction pretty quickly from like an outside in perspective. And so those processes can actually move kind of quickly for us. And for me, in terms of like both sourcing, meeting the founder to actually like closing a deal potentially, especially if they have like either a term sheet in their hand or if they're syndicating around right now. If it's more in the earlier stage, then that can be like a multi-year journey of just like knowing where they are at in the pre-siege stage or siege stage and keeping contact and tabs on like as they develop, where do we think good entry points would be? Because again, like Series A tends to be like the space where I play best in. And so like tracking and knowing like what is the actual adoption of the product, how has sales been, how has growth been, and keeping tabs on that is more of like a multi-year journey, because like going from that pre-seed all the way to the Series A stage could be itself like a journey. And especially if you have like bridge rounds or extra safes that you're throwing in there, it could even be further out. And so like I say that like it could be, you should look at it as more of like building the network through those conversations versus like getting an investment outcome.
Okay, great. Dorothy, let me turn it over to you to ask some of the questions. Again, I apologize if we don't get through all the questions, just because of all the questions people are asking. Dorothy, do you want to jump in here and go for the first one?
Yeah, so one of the questions we have is around your due diligence. So are there specific traction metrics and milestones that you're looking for, and what kind of progress that you expect as you evaluate a prospective investment?
Yeah, I think there's like the benchmarks of like growth being, triple, or triple, double, and those kind of metrics, as well as like gross margin being like a software margin, or if it's a payments type company, like being akin to a typical payments company, as well as like the cash flow margins, all those things. Those are kind of like, there's so many documents that are out there and people generally like kind of know. I think those are easy to track and like generally to know and have good KPIs for. I think the more interesting part tends to be on the sales pipeline and looking in and actually seeing like which of these do they think are leads that are actually going to be convertible and like what is their profit. Well, we get it. What is the probability of them actually converting? Especially like as a VC, if you're a good VC, you should be able to always like back channel into that corporate entity and try and understand like where are they actually at in the sales process. And so you can almost channel check like how confident they are representing a potential sales deal to actually like how the corporate entity is potentially representing that. And so like those are good like KPIs that are like soft, not like on a spreadsheet to measure, but are always important to have tracking, as well as to also make sure that you're like the way that you're representing it, like the sales to your VC should be the same way that corporate entity is representing and thinking the sales processes.
So, I mean, just relatedly, you don't necessarily have a specific like, ARR that you're looking for at a, seed stage versus series A versus series B. No necessarily hard metrics.
I would say probably like generally like the series A stage would probably be like $1 million higher ARR-ish around there. And then lower than that, probably more in the seed pre-seed stage. But again, there's like no hard and fast rules. I've seen like series B companies that raised a lot of money and they were only like 2 million ARR. And so like, it's a venture market. So there's not always the best hard and fast rules with that.
Great, thank you. Okay, so we have another question from somebody else who asks, how are CVCs different from corporate strategy and development teams? Is there overlap? Do they work together, or do they tend to be more distinct?
It kind of goes back a little bit to what I was saying before about like how strict that strategy mandate is. If it's like very strict and they're basically investing either with a partnership contract in hand or investing with like a very explicit intention that this is like an M&A deal down the road for them, I would think of that not as like a very venture-oriented investor. I would think of that as basically like you're interacting with like a corporate development team. And so your motion to that conversation should be like, this potentially could be an acquirer of me as a startup down the road, and whether that's a comfortable position I want to have, as well as like what contractual terms will they bargain with that might be preventative to me getting to any other commercial deals with any of that company's competitors. And so that tends to be like where the strategy focus or a corp dev team might differ from a CVC or like a more kind of looser strategy CVC, where they're more comfortable if, a startup has multiple commercial agreements, as long as the startup's hitting scale and we're not concerned about their financial health. Whereas those ones who have like a very strict mandate that's almost like a corporate development team, that will be where they are purely looking for the benefit of the corporate entity, and they're seeking commercial terms that would generally be pretty restrictive or hard for a startup to navigate, especially if they're trying to sell outside of that. And so it could play itself a lot, especially if you're selling like financial services, where like a banking institution that's pretty much using more of the corporate development model is really just trying to prevent any other bank from using that startup. And so like always entering those conversations, knowing that that might be at play if you're dealing with more of like the corporate strategy or corporate development type of CVCs.
That's a really good tip. Okay,
Dorothy, maybe one last question.
Yeah, this is the last one we have time for. Arun, you mentioned that there, in some cases, when you're looking at potential startup investments, there's ones where you feel like you personally can add more value. So can you tell us a little bit more about how you, support startups, and how often are you connecting and working with them? And are there, particular sweet spots that you like?
Yeah. I think generally like it depends if they're actually interested in like a commercial arrangement with Capital One, then like there is the access point of like introducing them to product managers, lines of businesses, and like having commercial conversations if they're not actively in a contract. If that's not something they're like after too, there's the benefit of like the network effects that like as a CVC you can have, which is either syndicating off to other CVCs who would be more of a better commercial fit, as well as the network of venture-oriented investors that a CVC also has access to, which is typically a little bit different than a financial VC. Whereas like if you're a seed stage investor, and you pass on a deal, you might hand it off to another seed stage investor. Whereas like if I pass on a deal, I could hand it off to another growth oriented investor, a seed stage investor. I generally have a network that spans the capital stack, as well as like people who are like facility providers if you need a credit agreement. And so like that flexibility with the capital is super useful if you're needing more like balance sheet oriented capital or later stage capital than if you're just purely looking for like seed stage. I say that too if like you're purely looking for like that safe note or early stage type investment, then generally like someone who's like embedded into that network would probably be your best way of like finding value.
Awesome. Well, Arun, what's the best way for founders to get in touch with you? Is there a best contact method?
Yeah, I generally prefer email. I'm happy to drop my email in the chat if that's useful to anyone.
Yeah, that would be great. Yeah, thank you everyone. And well, thank you everyone for doing the talk. Super interesting, very different perspective from a CVC, super informative. And